Thank you so much. I'm Wade Arnold. I'm the founder and CEO of Moov Financial. And Alex asked me to talk about the future of payments. And if you know me at all, I'm probably more comfortable talking about how exactly your EMV chip works on your credit card, or exactly how the clearinghouse's real-time payment networks work. But Alex said you all would be very bored if that's what I talked about tonight. And so I want to start the evening with a simple question for tonight's conversation, which is really what has changed in payments over the last decade. And I think what's changed in payments over the last decade is the easiest way to think about what's going to change in the decade to come. And so there's really three trends that I think define the last decade inside of payments. The first is peer-to-peer real-time payments. Onboarding and underwriting, super exciting topic there. And expanding customer segments from the underserved. So let's dig into peer-to-peer payments. So peer-to-peer payments, or P2P, is nothing new in the United States. In the early 90s, you could pay your friends via your bank's bill pay via check-free. But behind the scenes, check-free actually sent your grandma a check, is actually how that peer-to-peer payment worked at that point. And then in 2010, there were companies like Pop Money, People Pay, iPay, and they really actually changed things because they allowed consumers to sign up, and that allowed you to pay somebody based on a phone number or an email address. So no longer transferring account and routing numbers between two people. At the same time those companies were really taking off, Venmo was launched. So unlike its competitors, Venmo didn't charge users to send or receive money. Today, Venmo exceeds 260 billion in annualized processing volume across 500 million global users. And so I think there's a real question about what changed in peer-to-peer payments that have allowed Venmo and Cash App to grow into these iconic brands that we all use today. So the first thing is they didn't require a bank account until you needed to withdraw funds. Every other peer-to-peer payment mechanism required you start with a bank account. Second, the immediacy of funds changed the game. To consumers, money was instant. Even though it's on the ledger inside of Venmo or Cash App, to a consumer, it felt like they instantly received those funds, much different than check or ACH. And each had an incredible user experience in order to look up and find other users on the platform, which really led to the viral growth of both of those platforms. And then kind of last but not least, they offered the user to decide how to bring money in or bring money out of the platform. So rather than forcing a fee or different ways of getting the money in or out, they just offered every option. So what's the takeaway from that? How does that change how we think about the next decade of payments? And to me, P2P charted the course for consumer expectations. They want it easy and instant. That is starting to translate into other payment flows from business to consumer, business to business. We can learn from the P2P experience we now enjoy and bring that to consumers and all other payment methodologies. And I think we're going to see that unfold in the decade to come. So the second topic I want to talk about is onboarding and underwriting. So in 1958, Visa, American Express Card, Bank AmeriCard were all launched. So how can we possibly have any innovation inside of card processing inside of the last 10 years? You would think everything was already solved. And in 2009, both Square and Stripe were founded. And within the next 2 years, they were the first official PayFac programs that were launched by MasterCard and Visa. And so over the last decade, these two companies have changed the face of payments by creating a drastically new way of onboarding and underwriting their customers. I really think it's incredible that in 2011, Stripe was the first payment company to allow same-day enrollment into accepting payments. The caveat was they waited 7 days to let the money come back out. Patrick Collison stated in 2011 in regard to instant onboarding, quote, It has taken a ton of work, and there's good reason that no one has done this before, but it's also the one part of the product we're unwilling to compromise. We always wanted a payment system that we could just go live with immediately and not have to fax documents or wait till the next day for them to call us. So a decade ago, instant merchant approval was the one part of the product we're unwilling to compromise at Stripe, not the payment processing, the onboarding experience. So we're all familiar with this famous tiny square card reader that is now displayed in the New York City's Museum of Modern Art. The Square founder story that Jim McKevely missed out on a $2,000 sale of his glass faucets because he couldn't accept a card is kind of a mind-blowing concept today. But back then, to accept a physical card, you needed 6 months of bank statements, a physical address that the card reader was going to be stored at, a capital reserve account, and then significant investment into a point-of-sale device. Jim was like millions of small businesses owners around the country that couldn't accept a potential card. And Jim and Jack Dorsey set out to solve the problem and ended up with literally a free point of sale. If you remember, you could sign up and they'd mail it to you. That empowered millions of businesses. So what change in onboarding and underwriting have allowed Stripe and Square to grow to these iconic brands? First, in both cases, the payments industry stated that nobody would pay the processing fees that both of them charged. But both of them were just not payment processing companies. They were making life easier to create new businesses or new revenue sources. And this will always be the case. Stripe made selling online possible in one day. Square made accepting card payments in the physical world possible for millions of small businesses. These companies were created to make onboarding and underwriting simple. This is the first step of accepting payments. They both lowered the bar for businesses to enter the marketplace. And so what does that mean for the future of payments? Digital transformation in payments is here. We have the modern ability to make information sharing and approvals much more automated than ever before, yet batch file transfers and even fax machines are still a reality. So like Stripe and Square did for onboarding and underwriting, we need to modernize payments beyond the actual transaction itself. Improving both processes, operations, predictability for business and small business is absolutely critical to expediting and improving customers' experiences in the digital world. The last topic is expanding customer segments from the underserved. So the past two examples started their differentiating service by underserved markets. The same is true for many of the neobanks and other payment technologies and traditional financial services. So take micro investing platform Robinhood as an example. Before Robinhood, anyone who wanted to invest in stocks would be charged $5 to $25 a trade. They also needed to invest at least $500 to open an account. In 2015, Robinhood launched as a free trading platform. The number of funded accounts grew from 500,000 in 2014 to up over 23 million in June of 2022. Robinhood has since expanded its offering to figure out more profitable ways of monetizing those customers. Similarly, the neobank Chime is another great example of taking a different approach for an underserved market. Chime's current success comes from its mobile-friendly approach for banking that appeals to, frankly, cash-strapped millennials. Chime includes overdraft protection called Spot Me, which has to be the most unbank marketing term ever. Their early deposit system, which allows customers to get their paychecks up to 2 days earlier. Mind you, that's always been true in ACH, but they made it a product feature. They have no overdraft fees under $100 of your overdraft. So these features focus on an underserved market. You know, they're probably customers that most banks didn't even want in their nice branches. And now they've grown to servicing over 14.5 million consumers. These all have a common theme to them. Start with the underserved, which are typically unprofitable for legacy economics to serve. The pattern for growth is consistent in every company we have covered. Start with an unbanked or underserved, grow into retail, SMB, growth capital, global corporations. I can remember when Stripe came out, people said, oh, that's a great company for Beanie Babies, selling Beanie Babies online, if you remember those. Now almost all global corporations utilize them. So what's the takeaway for the future of payments? Help those who need help, because it's the right thing to do, and by the way, it's critical for our economy and for you to differentiate in the marketplace. Bringing people into the financial ecosystem that have felt invisible, such as the small businesses that Square helped, or the new online retailers that Stripe helped, or the first-time traders on top of Robinhood. You can't help but be inspired to improve the financial wellness of fellow Americans. It's as simple as offering a faster payment option so that small businesses don't have overdraft late fees or high interest loans. I challenge folks across the industry to never forget the impact what we do can make when it comes to payments innovation, but more importantly, to the end users that use it. So after covering kind of these three patterns, what is the future of payments? Last year, only 1% of US transactions were processed over the clearinghouse's RTP network. Next year, FedNow goes live. The combination of these two networks allow real-time settlement 24/7, 365 to every US bank account. That's a big deal. Big market there. But these networks themselves are just simply a payment rail. No consumer is ever going to go figure that out on their own. It is up to us to finish the proverbial last mile and create the future of payments. So I believe the successful applications of the future will follow the successful patterns of the last decade. By learning from what made peer-to-peer real-time payments successful with consumers and apply that to new opportunities. It will have a simple onboarding and underwriting in order to add businesses to the network. I assume the first use cases will target the underserved and then expanding customer segments. So Jenny Chappell on my team drew an analogy on a recent podcast that I really love. Real-time payments is legacy batch payments to what 5G is to dial-up. The industry is laying the groundwork for the new infrastructure that can change how we transact and how businesses communicate and exchange data about money transfers. And it's up to all of us in order to make that happen. Thank you.